Welcome back to the channel, commodity warriors and value hunters. Grab your notepads because today we're dissecting the copper bull thesis in raw, unfiltered detail. Picture this, a metal etched into human history from the Bronze Age to powering the AI revolution, now facing the biggest supply crunch in decades while demand rockets from EVs, renewables, and data centers. This isn't speculation, it's a collision of underinvestment, structural deficits, and unstoppable megatrends that could send prices soaring. Buckle up, by the end you'll see why copper might be the trade of the decade. Copper's supply story starts with a massive underinvestment hangover. After the 2011 commodity supercycle peak, miners slashed COPX by 50% or more, prioritizing dividends over digs. Exploration budgets cratered 70% from 2012 peaks. Fast forward, we're in a lost decade with zero new Tier 1 mines, 500,000 tons per year capacity, breaking ground since 2008, and only a handful of Tier 2s. Ore grades? Down 40% since 1991 to a measly 0.6%, meaning more dirt for less metal. Production costs spiked 20 to 30% in real terms. Aging giants like Chile's Escondida, world's largest, and Grasberg are depleting fast with grades halving. Disruptions pile on. Water shortages in Chile, 40% of global supply, labor strikes, Congo conflicts, and Panama's Cobre Panama closure, 0.3% global output offline indefinitely. New mines? 17 years from discovery to first pour, $5 to $10 billion each, with 80% of projects stalling. 2026 outlook? ICSG pegs a 150 KT deficit, S&P Global 400 KT plus, JP Morgan 330 KT. Cumulative shortfalls hit 5 million tons by 2030 without heroics. Recycling covers just 20 to 25% of demand and can't scale fast. Primary mine supply peaks mid-2030s, then drops 1 to 2% yearly. LME stocks? Under 100 KT, a 2-week buffer. Shanghai warehouses empty. Every barge delay or strike now equals fireworks. Copper's conductivity makes it irreplaceable. Enter the electrification tsunami. EVs? 40 kilograms per Tesla Model 3 versus 20 kilograms gas car, scaling to 80 kilograms in Cybertrucks. Global fleet hits 250 million by 2035, adding 5+ million tons demand. Chargers, another 1 to 2 million tons. Renewables, offshore wind turbine equals 5 to 7 tons, onshore 3 to 4 tons. Solar farms 5 tons per megawatt. Grid upgrades for intermittency, double U.S. transmission copper by 2030. AI and data centers steal the show. Power demand triples to 200+ gigawatts by 2030, 8% U.S. electricity. Each hyperscale facility wiring 1 to 2 million meters of copper cable, plus transformers and cooling loops, 10x cloud 2010. Defense surge, drones, hypersonics, and emerging markets, India's 8% GDP growth, and Southeast Asia infra add fuel. China's stimulus rebounds construction. Totals? Demand climbs 3.5% CAGR to 28 million tons in 2026, 43 million by 2035, a 24% jump. By 2040, 10+ million ton annual deficit unless supply triples. Impossible without policy miracles. History rhymes hard. Bronze Age collapse, copper shortages toppled empires. 2008 spike to $4.60 per pound starved supply, birthing today's cliff. Post-2015 oil-style discipline killed juniors, permitting delays now 10+ years. Last bull, 2021, tripled prices on COVID infra. 2025 records echoed it amid early deficits. Bulls like 2003 to 08 lasted 5 years, rewarding cycle spotters with 5 to 10x miners. We're early innings. Banks align. JP Morgan $12,000 per ton 2026 average, UBS $13,000. BHP and Highland, $15,000 peaks. Technicals: 200-week uptrend, golden cross, seasonality favors Q4 to Q1 surges, 87% positive. Bears cite China, 35% demand, slowdowns or recessions, but energy and AI tailwinds trump macro noise. Goldman sees $10,000 to $11,000 base with upside. $20,000 per pound by 2030? Not crazy if deficits compound. Early cycle squeezes like 2026 favor layered asymmetric bets, pure copper scarce. ETPs and ETCs track spots seamlessly. US CPR, contango hedged. EU copper ETCs, no storage tax. Levered like COPX, 2x miners for torque, but volatility demand stops. Miners amplify. Juniors, sub-$500 million market cap, rocket 5 to 10x on discoveries or drill results in deficit frenzies. Target 3G per T plus grades, Tier 2 potential, clean jurisdictions, AUS/CAN. Mid-tiers, $2 to $10 billion market cap, expand output 20 to 50% via brownfields, lower risk. Majors, BHP, Rio, and FCX, diversify with iron and gold, but lag pure plays. C1 cash costs $1.5 to $2.5 per pound signal strength. ETFs democratize. COPX producers pick broad metals copper heavy. Streaming and royalties, RGLD/FSM fund mines fee-free, 30 to 50% margins on revenue share. Physical? Bars or coins via APMX, but premiums and storage bite long-term. Cycle fit. Stack juniors early for binary upside. Pivot mid-cycle to cash flow machines as CapEx booms. Map reserves. 50-plus years mine life ideal. AISC trends. Debt under 1x EBITDA. Research theses beat tips. Pair with macro dashboards for entries and exits. There it is, the Copper Bull Thesis unpacked, from ancient forges to AI servers. If your pulse is racing, hit like, subscribe for more deep dives, and comment Red Metal Rocket. What's your cycle play? Catch the next super cycle wave. See you there.